In this video talk, we're going to step you through how evergreen equity splits function as tools for good stewardship. The goal is to sustain the corpus of your entrusted funds so that you can sustain your ability to pay out the benefits that you are entrusted with paying out. So we're looking for programmed performance that will deliver principal protection, actuarial returns with transparency, integrity, and a subordination of incentives. Here we have a hypothetical portfolio which is designed to achieve the sustaining of corpus and benefits. And first, we're going to see these numbers are in billions of dollars. We're looking at a portfolio that includes three companies: Procter & Gamble, Schlumberger, and Microsoft. The investments in this portfolio are substantial. This sums to $353.42 billion. We've built this over a 20-year base case. This is not to indicate that these companies won't continue beyond 20 years. We expect they will. This portfolio will probably continue. It will continue as long as these companies would continue. But the base case is the event horizon within which we've architected our program performance. And this portfolio is being programmed to deliver a 13% IRR over the 20-year base case event horizon on a $353 billion level of fiduciary funds being prudently invested. And this is not adjusted over time for inflation or reinvestment or anything. We've just kept that flat to keep things simple. When we talk about a program performance, we're programming earnings to meet your fiduciary obligations. And we have these line items that go into calculating what those obligations are. We have a makeup for inflation, which is budgeted at 2%, and then paying out your fiduciary benefits, which is budgeted at 5%, and funding your own cost of administering it at 1%, so your total cash need is budgeted at 8%. That translates into an annual cash need of $28.27 billion on this $353.42 billion of fiduciary funds being looked at in this portfolio. So we have the earnings coming out of our investments every year, starting at $42.28 billion and growing over time to $67.03 billion in year 20. We're applying a portion of these funds to recovering our capital in every year, except that as you get out into the later years, you see there's no additional funds being applied to capital recovery, and that's because by now we've fully recovered the $353 billion. And so all of the cash earnings from the investment are also earnings to your fund. This leaves what was left over is what's available for you to meet your fiduciary obligations, and you can see this portfolio during the first 10 years or so anyway provides just enough cash after capital recovery to fund your current obligations, but after capital is recovered, you start getting these very large surpluses. And down here, this shows how capital is getting recovered in increments over time. This money, of course, along with these surpluses and along with these allowances for inflation, that would all be getting reinvested. And so you'd have actually your fiduciary funds would be growing, and the amount of wealth circulating through your portfolio would actually be larger than this. But we wanted to just keep this simple presentation so you can understand how the equity splits architecture works to a program performance. The concepts we're working on: this is a going private, staying private strategy where we take companies close to this inflection point where this high, steep sort of exponential growth period, which Wall Street does so well with, is kind of leveling out to more of a stable, steady organic growth profile. And we take these companies out of the Wall Street paradigm to put them into an equity splits paradigm where we think there's a more authentic match. In architecting this portfolio, we were selecting mature companies that were dominating established markets. We want to make sure we're looking for very healthy, robust companies, and the key for that is we can see that they are spending proper sums on maintenance and innovation, R&D, included in their operating budgets. We're looking for big companies because that will attract less competition. We want to be able to execute these types of strategies without the distortions and disruptions that speculators and arbitrageurs can create. Our hypothetical shows 100% stewardship funding of this portfolio and the portfolio companies, but you should consider whether or not a coattail strategy would work for you, where you as a steward would take a control position in a going private transaction, say 60% of the deal, and then leave retail investors the opportunity, if they want to tag along, let them participate in this strategy, which is actually much better for them. When we're structuring the portfolio, we're looking to increase our use of debt to match the stable, steady growth profile of the going private enterprises and make more efficient use of low-cost debt, and also take advantage of the tax deduction you get for interest. We do look to pay out 100% of our current cash flow. That's the primary source of investor exit. You're not letting your principal ride. You're not having to sell out to get out. You get to stay in and share in the cash flow of the company. That means, of course, that the company can't control reinvestment. It has to identify new opportunities and get them funded on a standalone basis, which we think just improves the discipline of the leadership. There's no need in this portfolio to pay exorbitant outside manager fees. The sort of traditional 2 and 20 isn't here, because as stewardship investors, you can build in-house teams included in that 1% number to look after your base case, and the outside architects who you bring in to construct these portfolios would get a split of the splits that they construct as their compensation. Portfolio details. Here are the key statistics. We sourced this from Capital IQ via Yahoo Finance. We selected these numbers on May 16th, a couple of different times of the day. So what we pulled out as the key relevant numbers: the revenues, the EBITDA is a proxy for cash before tax, the shares outstanding and the price per share to get to a market cap, the debt on the balance sheet, which sums with the market cap to give us our targeted going private price. Then there is the adjustment for the taxes to your EBITDA. And we also looked at short-term investments on the balance sheet, because these could be a source of financing for the going private transaction. And here it's important to make this point. We looked at short-term investments, but not cash and cash equivalents. Our convention is that the cash and equivalents represent working capital that has to stay inside the company, but the short-term investments are surplus cash that can be used more efficiently in a going private transaction. So when we picked Procter & Gamble, we're looking at $83.72 billion in revenues. That's generating $19.7 in EBITDA and cash flow before taxes. They have 2.74 billion shares outstanding. The price when we ran these numbers was 80.04, giving us a market cap of 219.37. Now, that's one of the issues with the public markets. Of course, these numbers bounce around, not because the business is doing anything differently necessarily, but because the expectations market is doing different things. Anyway, they got 32.22 billion on their balance sheet, so that gives us a $251.59 billion going private price. When we adjust EBITDA for taxes, we're looking at their last full year provision, and that was 3.468. And these guys don't have any short-term investments on their balance sheet. When we look at Schlumberger, a smaller company, their revenues are 42.9 billion, bringing 11.17 billion down to the EBITDA/cash line. They have 1.33 billion shares outstanding. When we did these calculations, their price was 75.86 per share. That gave us a market cap of 100.85 billion, had 11.1 billion in debt on their balance sheet. That gives us a going private price of 111.95 billion. And when we adjust for their taxes, their last full year provision was 1.723, and they are showing 4.369 billion of short-term investments on their balance sheet. The third company we picked for this hypothetical portfolio, of course, is Microsoft. Their revenues are 76.01 billion. They're bringing down 30.49 to the EBITDA line. 8.3 billion shares outstanding at a $34.05 share price gives us a $284.36 billion market cap. They've got 14.76 of debt on their balance sheet, and that gives us a going private price for Microsoft of 299.12. Their provision for taxes is 5.289 billion. And they've got a lot of money on their balance sheet, 56.102 in short-term investments. So here's how we built the sources and uses. For Procter & Gamble, there were no short-term investments to be liquidated. So we put 118.2 billion of permanent bank debt into the capital stack. That's up from 3222 that they have on balance sheet right now, and 133.39 billion in stewardship capital to sponsor the going private transaction and to cover our $251.59 billion going private price. For Schlumberger, they have 4.37 billion of short-term assets that we assume could liquidate as a source. There's 39.1 billion of permanent bank debt in the new capital stack, adding to the 11.1 already there. And we put in 68.49 billion of stewardship capital to sponsor the going private transaction, and that gets us 111.95, our going private price. For Microsoft, the short-term investments contribute 56.1 billion as a source. We put permanent bank debt of 91.47 on, up from 14.76, which they have now. And then we bring in 151.55 billion of stewardship capital to sponsor a $299.12 billion going private transaction. So this three-company portfolio in total uses 60.47 of company cash, 24.77 of permanent bank debt, and 353.42 of stewardship capital to fund $662.66 billion in total transaction cost. Now let's look at how we do the split strategies, because the goal here is to negotiate a base case, and there are lots of levers that we can use in architecting a base case that works. So with Procter & Gamble, for example, we start with debt as a multiple of the EBITDA. With PG, we went to 6. With Schlumberger, we could do it at 3.5. With Microsoft, only 3. PG is the most heavily levered of the three companies in this portfolio at 47%, Schlumberger at 36%, Microsoft at 38%. We also have to make some assumptions about the growth rate in the cash flows going forward over the base case. And here it was necessary because of the growth premium we have to pay in the markets for Procter & Gamble to assume a 4% growth rate. With Schlumberger and with Microsoft, we could really just assume monetary inflation at 2%. Then we get into the actual splits. And here we want you to think about the equity splits architecture as a step-down function. As specified financial milestones are passed, the sharing steps down to the capital sponsors, which means the business leaders are earning back more ownership and more control of their business. In this portfolio, we started with a priority payback, and for all three of the companies, we set that at a 95% cash sweep, so 95% of the available cash is being swept over to the stewardship investor side of the ledger until that 353 billion is repaid. Well, actually, it's company by company. The other 5% is going over to the business leaders, which they can use to pay themselves bonuses or to pursue other enterprise opportunities. This performance milestone we build in here is the 8% actuarial earnings assumption. And here you can see that Procter & Gamble and Schlumberger, we couldn't really step them down after the payback, that the 8% is at 95%. Microsoft, they could take 90% at the 8% level. Once we pass the 8% level, there is a step down again. This is a second milestone we built in here to a 12% IRR, but here that's based on 90% cash sweeps in Procter & Gamble, 90% at Schlumberger, only 85% in Microsoft. And then the ultimate goal was to get into a residual ratable sharing. Here we set it at 80%. In theory, we'd like to see that smaller, but these companies are so large, maybe it doesn't make sense. Because you want the business leaders to feel like they're earning back control of their company, and they're earning back the right to control the funds as they deliver on the base case and exceed that base case for you as the investor. And you can see here there are different return bogeys in these different scenarios. We architected the PG investment to an 11% IRR at year 20. Schlumberger, we architected to 12, and Microsoft to 15. Another measure of value is the multiple of original investment. For Procter & Gamble, it returns 2.94 times what we put into it. Schlumberger 2.83, Microsoft 3.24. So 3 times. Drawing our final conclusions then, we are sustaining your corpus of entrusted funds and your benefits to your entrusted beneficiaries through program performance that provides principal protection and exceeds actuarial returns with good transparency, integrity, and a subordination of incentives.